What is up, guys, and welcome back to the Blockware Intelligence YouTube channel. My name is Blake Davis, and we're back for episode 5 of Crypto Equity Investing 101. This episode, I think, is probably going to be a little bit shorter. I just want to intro the topic of crypto exposed equities, breaking down some of the key characteristics, a little bit about why there's so much demand for crypto equities, and then I also want to intro the topic of relative strength by looking at an example of identifying areas of strength between a crypto equity and using Bitcoin as an index. We've gotten a lot of good feedback on the first 4 episodes, so I appreciate all of those who have been following along with the series and taking time to comment. As always, please keep in mind that none of the information in this series is investment advice. I am not a certified financial advisor, and that nobody should pursue any investment strategy without first conducting proper due diligence. With that being said, let's get into it. So, what is a crypto exposed equity? I think you can group them into 2 primary baskets. First, you have the crypto native, or you'll also hear me call them the crypto related equities. And these are probably what you're thinking of when you hear crypto exposed equity. These are companies whose day to day operations are primarily focused in the crypto or Bitcoin industry. So, these are going to be your miners, your stakers, your exchanges. You can see here on that list on the left, I've included Riot, who's a miner. I've also included Silvergate, and Silvergate isn't 100% Bitcoin focused, but their product, the Silvergate Exchange Network, is massively important to the industry, and their stock price pretty much just tracks BTC. So I think it's enough that we can put them into this crypto native category. It's the same with MicroStrategy, right? MicroStrategy is a data analytics company, but because their primary balance sheet strategy is buying and holding Bitcoin, their stock price also tracks Bitcoin. So I think that we can put them in this crypto native category. And I've also included Marathon as another example of a miner. And then this other basket is more the crypto exposed. And I think, crypto native companies can fall into this crypto exposed basket. Their stock price and their company's objectives is exposed to crypto and how well the industry performs. But there are companies that are solely crypto exposed. So what I mean by that is these are companies whose day-to-day operations and objectives are not related to crypto, right? They might have a one crypto product, one Bitcoin product, or maybe they hold a small percentage of their balance sheet in Bitcoin. So I think they stand to benefit if Bitcoin in the crypto industry does well, but this is not their primary objective. So some examples of companies like this I've put on there, PayPal, Robinhood, Square, Tesla, just to name a few. But every month, every quarter, the number of companies that are becoming exposed to crypto is growing. So now let's talk a little bit about why is there demand for owning crypto equities instead of just owning the crypto asset itself, right? So it would make a lot of sense to say, why would you want to go own shares of MicroStrategy instead of just owning Bitcoin itself? And I think a lot of this answer lies in the fact, as we've discussed here in the past, you need institutional accumulation and sponsorship in order for stocks to go on these massive runs. So we need to track institutional behavior in order to understand why there's demand for these equities. I think one of the first answers would be this ease of purchase or this familiarity with owning equities, right? Most people have some form of equity account, a Roth IRA, a 401k. So the fact that millions of Americans already have stock accounts and own equities, there's this little bit of comfort. I think that comes with finding an avenue to be exposed to Bitcoin through a traditional finance method. And that's not to mention that it can be a little difficult for legacy or traditional finance funds or fund managers to justify going out and buying actual Bitcoin to their clients. So instead of having to explain the process of buying Bitcoin on an exchange, potentially moving that off exchange to self custody it, why not just buy X amount of shares of MicroStrategy, for example, which essentially just operates as a derivative of spot Bitcoin price action. Another reason is you have equity only funds. There's a fair amount of them out there. So you have funds that cannot own anything other than shares of stocks. So this provides these funds with an avenue to be exposed to Bitcoin and essentially own it just without actually going out and purchasing the Bitcoin. There's also this idea, with all equities that if you're able to grow your earnings and increase the value to your shareholder, quarter over quarter, year over year, you can create returns that are stronger than the index. So if you're a miner and you're bringing on hash power every quarter, you could potentially see stock returns that are much stronger than Bitcoin itself. So I think that's, brings in a lot of traders as well. It's become fairly popular to trade these stocks instead of just trading Bitcoin, because you can see returns that are even better than Bitcoin's. And you also, part of that has to do with there's a risk premium with equities, right? There's counterparty risk, which Bitcoin doesn't have, right? You self custody your Bitcoin. The only person you have to trust is yourself. But that's not true with equities, right? You have to trust the CEO, the managers, the employees to do their jobs, as well as they say they're going to do them. So because there's that inherent risk with owning shares of a company, there's also this, risk premium. People expect a higher return, which can create even more volatility in these stocks. So as I just talked a little bit about, crypto equities in general are just a higher beta, a higher volatility avenue for playing or investing in Bitcoin's price action. And this is something that can shy people away. Maybe if you're a little closer to retirement, you don't want that extra little bit of volatility, but it's definitely important and something to keep in mind. And we use Bitcoin as the index for these stocks to keep track of what's going on as a whole, and it's really important to obviously keep track of what Bitcoin is doing if you're going to be invested in these companies. So I think a good way to understand this is if we look at that December 2020 to that April 2021 top in Bitcoin, where we broke 20K. Bitcoin returned 226% from that previous 2017 all-time high, and in that time, Silvergate returned 265%. MicroStrategy made 342%. Marathon was 534%, and Riot increased by 704%. In that time, the S&P only returned 12%. So, there is this inherent volatility that comes with owning these stocks, as I just explained, due to risk premiums. I like to think of those larger crypto equities, those larger cap crypto equities to Bitcoin in the same manner as your big cap Tesla, Apple, Amazon is to the S&P. And it's not exactly the same. Obviously, the S&P 500 is a stock index. So if Apple, Amazon are starting to perform really well, they drag the index higher, which obviously isn't true for Bitcoin. Bitcoin is not a stock index, but what we actually have seen in the past, and recently in this bear market too, is because institutional accumulation is so important, a lot of times they'll start front running their positions. If they know they're going to start bidding Bitcoin, itself higher, they will sometimes start to build positions into a Silvergate or a MicroStrategy, whatever. So sometimes we've seen these stocks start to creep higher before Bitcoin and kind of front run that move. So I still think it's very important to keep track of not only spot Bitcoin price, but also looking at some of these bigger cap miners, exchanges, crypto native equities to start to understand what's going on throughout the full spectrum of the industry. So now we could talk a little bit about relative strength, which I think is a super, super important topic, which I haven't touched on too in depth here in this series yet, but I think I'm going to do a full video on it maybe next. But essentially what we're looking at is the strength of an individual stock relative to the rest of the industry group or an index. So for crypto equities, I use Bitcoin as that index. There's also WGMI, which is Valkyrie's Bitcoin mining ETF. That's pretty illiquid. There's not too much capital built into that ETF at this point. So I think just using Bitcoin is probably the better avenue for it. But what I'm looking at here is the that bull run I just discussed in late 2020 into that top in 2021. And what I want to focus on is here. This flag. This is what I'd call a flag pattern. So this is your flag pole, and then this would be the flag itself that Bitcoin built what's that, January of 2021. So I want to compare that to this chart of Riot from the same period of time. So I'm focused here for Riot, and we're focused here for Bitcoin. And what you see is, we really want to keep track of these key moving averages. So right here in red, this is the 50-day, which, if you remember, I like to call the guardrail. This is what I think is probably overall the most important moving average to keep track of. And you can see Bitcoin is basically sold off back into this red 50-day moving average. And if you notice, Riot didn't really come too close to it. And that's just a testament to the strength of Riot over Bitcoin. right? You had selling in Bitcoin all the way down to the 50-day, but for Riot, it barely even really broke that blue 21 EMA, right? It only spent, whatever, 1, 2, 3, 4 days below it. Versus with Bitcoin, we had, 1, 2, 3, 4, 5, a bunch of days below that 21 EMA. So I think, that's a testament to the strength of Riot. And what we saw happen is we had this explosive move. This is a logarithmic chart, so it might not look too crazy, but I mean, if you're here around $20 and it peaked out above $70. I mean, that's a massive run in like 2 or 3 weeks. So that strength of Riot over the index over Bitcoin was kind of a clue that this run wasn't totally done, right? People weren't really selling too heavily in here. I mean, you have one pretty significant red day, but that's outweighed by this massive green volume bar here. You have a few more pretty sizable green volume bars in here as well. So what we saw is like institutions weren't really unloading positions, and you could argue that they were accumulating down here at the bottom. So that is the basics of relative strength. Is we're looking for strength relative to the index. So this, I think, is a really good example of what we're looking for if you're interested in investing or trading crypto exposed equities. Is we want to see strength relative to Bitcoin itself. Now, also here at the end, I want to talk a little bit about ways to evaluate miners because, off the bat, you might think they all are basically doing the same thing, right? They're all mining Bitcoin, but, not all of these companies are built equal. So I want to start off with my personal favorite way to evaluate miners, and that is through price action, right? By looking at the relative strength of an individual company in comparison to the returns of Bitcoin. One way I go about doing this is by every week comparing how far Bitcoin's price has moved that week. I also use WGMI, that ETF, and then looking at individual stock returns. So let's say Bitcoin's down 5% that week, and if you have a stock that's up 2-3%, whatever, that's a sign of relative strength, and I think that's something that you should note. So every week in our Blockware Intelligence newsletter, I include a Excel sheet which compares those returns for free. So if that's something you're interested in, highly recommend going and subscribing. Another way we can evaluate miners is by looking at their hash rate, right? So how much mining power is that company deploying into the network? And obviously, unless you don't fully understand Bitcoin mining, but by spitting more hash into the system, you're essentially creating a higher opportunity to create revenue. So just by looking at hash rate, we can see, exactly how much mining power that individual company has. And then furthermore, we can divide the market cap of the company, so the stock price multiplied by the number of shares outstanding, which would be the amount of capital that's been fed into that stock, and you can divide that by the hash rate, so you can see exactly how much money is the market, is Wall Street, whatever, attributing to each unit of that company's mining power. And I think it's useful for a few different things. First of all, if you have a company with a pretty high market cap to hash rate, institutions are looking to pay a premium for that hash power. So, that could be for a few different things. Maybe they have, cheap energy, so they have higher earnings. Maybe they just have a really good team of, managers or, their C-suite or whatever. You could also say that if they have a pretty low market cap to hash rate, that potentially they're operating at a discount. Their stock price is operating at a discount to the mining power that they're deploying, which would be an argument that they're undervalued. That's personally not the way that I go about investing, but there's certainly an argument to be made that it could mean that. And then there's also the traditional methods of evaluating stocks, right? You could do discount cash flows. You can just look at earnings per share. You could compare revenue numbers. There's a million different metrics there. Like I said, I'm not too keen on, valuation metrics in general. And that's why I love relative strength because as we discussed in episode 1, price is king, right? It doesn't, if your market cap to hash rate is low, maybe you're undervalued, whatever. But that doesn't matter if the stock price isn't increasing and you're not making money doing it, right? Price is king. Price is the only thing that pays. Even your hash rate technically doesn't matter if your stock price isn't reflecting that. So that's why relative strength is my personal favorite. I'm big on price action, but I just wanted to present all these metrics for you to look at and make your own decisions. But yeah, that is all I have for this week. I appreciate you guys sticking around to the end. If you liked this, as always, feel free to like, subscribe, comment some feedback, and I will see you guys with a video next week.